There's definitely some tailwinds, that are coming in 24 and 25. I mean, the first one and the main point is there's a shit ton of commercial debt coming due. In 2024, there's 659 billion in commercial loans that are slated to mature, and in 25, there's 539 billion. So in over the next 2 years, 1.2 trillion dollars worth of debt will mature, and so groups are going to have to figure out what they're going to do with their properties. If they haven't added that value, they're probably going to be looking to sort of fire sale, or get out of it at least what they got into it for. And it's that is certainly going to create opportunities.
Well, let's unpack a little bit debt maturing. What does that exactly mean, right? So that means that if someone traditionally in commercial real estate, you're usually getting, on average let's say a 5-year term, right? 3, 5, 7, 10-year balloons they're called, right? So
or it could be short-term debt.
Could be short term, right? Yeah. So, but generally you're on some sort of schedule like that. In commercial real estate, you're not going to get, like with a house, you'll get a 30-year term, right? That's not really, there's certain vehicles you can do that in commercial real estate, but it's not the norm. So when he says matures, that means the bank's going to need that money, right? So if you got a loan and you have $2 million loan with the bank, when that loan comes due, and that's what I mean by a bunch of this maturing over the next couple of years, the bank has the authority to say, hey, you owe us $2 million. I'm going to need that money. Right?
Yeah.
We don't want to renew the loan, or the appraised value is now lower.
Exactly.
So you got to have the cash to cover it. Otherwise, you got to go out and fire sale it, right? If you owe $2 million to the bank, but the property's only worth $1.8 million because you overpaid for it, you didn't add value to it, you might have to go out and fire sale it for $1.8 million and then stroke the $200K out of pocket just to get the bank off of it.
Exactly. And the difference between a 3% interest rate on your mortgage and a 7% interest rate is really high. That makes for that's a whole different world, right? So to be able to what we call service the debt, or be able to afford the debt, let alone cash flow and put some money in your pocket every month, that's what we were talking about, where you got to be able to add value in some way, shape, or form to those deals before that loan matures and the bank's calling and saying, hey, it's time to pay up or pony up that dough.
Well, I think so many people, when rates were, at 3%, it was a great time to buy, right? But you still have to buy right. I honestly think there's also a geographical component too as well. I think certainly like southern markets, or the hot markets, right, that everyone was investing in.
Yeah.
People were paying insane prices, right? Yeah. Cap rate wise, people are paying 3 caps.
Yeah.
Right. And it's like, okay, like you said, when your interest rate, your mortgage payment doubles.
Yeah.
And you didn't add the value to the property, you didn't increase the value of it, the cash flow doesn't support it, right? The cash flow was already tight. People were buying it when this at 3% rates.
Yep.
Now they're at negative cash flow.
Yep.
And unless you have deep pockets and you can afford just to write the check in cash to keep it afloat, you're gonna have to sell.
Yeah. Yeah, it's crazy. And there's other like you were saying, regionally, and different asset classes have different sort of tailwinds and sort of growth trajectories. But the main thing is, in commercial real estate, and real estate in general, interest rates drive the market, right? So that's the biggest point. And we're likely to see some opportunity because of all this debt coming due in the next 2 years.
So asset specific, I'm just looking down at this graph I actually read this morning. It's really interesting stats. So
shout out to CRE Daily.
Yeah, it was on there. It's a great newsletter, by the way, for you're looking to learn more about commercial real estate. So it talks about outstanding distress and potential distress. And of course, the biggest asset class with the most outstanding distress is office, right? So there's $34.5 billion in outstanding distress is what it means in office. But the one highlighted as the most potential distress is apartments at $67.1 billion.
Yeah.
So it's kind of interesting. And this article kind of talked about as well, we're talking about the markets, right? The southern markets and these kind of more booming markets are going to see more of that distress.
For sure.
But it's interesting to kind of see that flipping, and then to also highlight the one with the lowest amount of distress on both sides is industrial.
And that's a good segue into why we're doing what we're doing. And so we saw so many, there was just a craze for buying multifamily. And I do love apartment buildings. I do believe that, America is becoming more of a renter nation. I believe that, you're investing in basically something that people have to live in, right? But you need to be a very skilled operator to be able to manage the expenses and to add the value of those properties. And I think during the time of very free, cheap money, a lot of groups went out and bought these apartment buildings and didn't really realize what they were getting themselves into. And they were just chasing that, hey, there's population demand, people are moving there, I'm going to buy that. And then a lot of people are kind of getting in over their heads. But specifically, why, and we kind of realized that we were buying apartment buildings at first. And then sort of as we got better and better over the last, 5 years or so, we started to narrow in on industrial as an asset class because we were solely seeking, where do we get the most predictable cash flow, the most predictable revenue, so that we can sleep at night and find opportunities. And that's been industrial for us. And so you want to talk through some of the reasons why we like industrial?
Yeah, for sure. So I think, we can talk through why we like that asset class specifically and why we think there's opportunity in 2024,
Exactly.
which has led us to what we're doing in our business right now, which is kind of restructuring into a fund model where we're going to go out and raise a bunch of money and be prepared to deploy it over the next 1 to 2 years into these distressed assets that come available. So we could talk first about the e-commerce pool.